Hello, everybody, and welcome to the Speaking of Insurance podcast. My name is Aaron Bollinger.
I'm Brian Bollinger.
Today, we are going to get into all of the nuances of higher net worth individual property insurance, different types of insurance for those types of people, and just in general, those higher net worth people, right, Brian? They got a target on their back.
Definitely, definitely. Yeah. I mean, I just was talking to a client today, need to have at least 5 million, trying to think about even $10 million of personal umbrella policies. These are kind of clients that might have a couple Lamborghinis, a couple Ferraris, pretty high net worth people. Their dreams have come true. They're the American success story. And now they're running around the target right now. It's scary for them.
Even if you aren't one of these people, I mean, obviously, we're not naive enough to think that the mass population of people listening to this podcast are going to be those people. It's still interesting to know about and definitely very important, whether you care about insurance, your own insurance, or things like that. It's just understanding what's happening, kind of, and things that we're seeing. It could be an insight into something that might have an impact on you somehow. I mean, it's a domino effect in this industry. So you had wanted to touch on some story or something in the insurance industry or something about Aaron, or I don't know, you said something before.
Well, I mean, we got that national, convention coming up here in a couple of weeks. But the thing I was really thinking about was just, talking about some of the projects we're working. I know you're working on a pretty large home in Brush in California, and it's interesting how the pricing is different, how the coverages are different. How each client will make a different choice. Some people might prefer to have the better, more deluxe policy, and other people might want to save 3 to 5 grand and maybe take something a little less substantial. Again, it's we understand it's expensive; it's a lot of money. At the same time, though, anytime you have a loss, every client we ever talked to, there's always some kind of unforeseen expense when you rebuild a house, something that's typically not covered by the insurance company. So to automatically reduce coverage seems tough.
Yeah, it does seem tough. It's three properties that we're working on right now. We got three of them that are somewhat near Brush. One in around Agora Hills, one Murrieta, and then the other one is in Westlake Village. So if you live in any of those areas, shout out to you. We know insurance is tough, and if you're one of those people owns their own house, I mean, God knows there's a bunch of different ways that you might be able to save on insurance. Something we can touch on, and you'd mentioned it right there. HO3 versus an HO5. So you get a quote from one person. One person says, "Oh, it's an HO3." One person says, "Oh, we've got a HO5 for you." Okay, this is a little bit complicated, but there's something called open perils, which means like if something happens, it doesn't have to be listed on the policy. There actually isn't a list on the policy. Basically, it should be covered by the insurance. So in an HO3 policy, there's like a list of things that can happen to your personal property. And if one of those things happens, you're covered. If not, you're not covered. In HO5, it's open perils. So it doesn't have to, be explicitly stated. And there actually isn't anything explicitly stated. So a broader coverage form. And it tends to
Still
also,
has exclusions, though, right? I mean, we still have to talk about the fact that
sure.
earthquake's
Yeah.
not
Well, there are
covered. There's some
exclusions,
things, but
but the
yeah,
things that are
I,
not
it's
exclusions
much
are
broader.
all covered.
Yeah,
Sorry.
it's Yeah, and they also typically on the personal property typically have a better, more of a replacement cost valuation, maybe a little more lenient in terms of how easy it is to get the claims handled and processed. I typically see, like when we do an HO5 versus an HO3 after a claim, we typically see the companies being a little more generous and easier to work with, assuming they're one of our preferred companies. Now, that's the other thing, right, son? You got, things from Chubb, which is probably one of the top ones. You got AIG Private Client out there, still a really good company. And then you go all the way down to some of these excess surplus lines companies, and it's quite a wide range, isn't it?
Yeah, it is. I mean, obviously, the quality of the company you can't immediately know off the bat, but if you hear a good name, you know it's a good name. You don't know some of the names. I mean, I don't know some of the names. I can't tell you if Verdant is the best insurance company or Attain is the best insurance company. I know Scottsdale, but those other ones I haven't personally worked with before, and they all have their own different appetites in different areas. But I think it comes down to your insurance broker, the coverage form, and understanding like what's the best. And hopefully all the quotes that you're getting are like the same. Like, oh, we have this replacement cost on our house. Oh, we have this personal property on our house. Like, I mean, if one person has a $6.5 million valuation, one of them has a 6.1, that is a big difference. It is a big difference, and
Well,
you have to.
especially if you have that extended replacement cost, right, where you might actually have not just that 6.1 or 6.5, but you get another 25 or another 50% on top of that. Like it's a significant amount of money that people, can have a difference on quotes.
Yeah, yeah, it is. It is. I mean, you work especially around brush and whatnot with a lot of excess and surplus lines carriers. That is unfortunately, I mean, obviously you'd want a big travelers or something like that. But again, you don't know if the E&S company is really good or really bad. It all depends on the coverage form, your broker, what you can figure out about that policy. And of course, you have a bunch of assets that you want to protect. It is very, very, very important, I would say, that you have a very broad coverage form. And again, HO5 tends to be a little bit broader. HO3 tends to be a little bit more restrictive. And another big difference is deductibles. If one of them has a $25,000 deductible, you got a quote on your, let's just say realistically, like $2-3 million house. If you're more than that, please contact us. We can give you better examples. If you're $2-3 million on your house and you have a $5,000 to $10,000 deductible, that's probably around the ballpark of what it should be. But if somebody comes in and quotes, "Hey, we've got this great quote, $5,000-$10,000 deductible on your house that you're paying, 10 grand for right now, 20 grand for right now, and we're half that." And then you look at it and it says, "Oh, there's a wildfire deductible," which you learn new things every day. I didn't know that a wildfire deductible could go up to $100,000. The other day, I just saw one, like $100,000 that you'd have to pay out of your pocket in the event of a. So like literally, you lose everything in your house, and you have to work with the insurance company on making sure it's covered, and you've got to pay $100,000. $100,000. I mean, if
Well,
you've
they
got
do
a
that
million
too.
pounds
Don't
on
don't
hand,
forget, like some of these smaller fires people have had. We all want our houses perfectly clean now. A lot of places usually actually have wood burning fireplaces, not just in cabins but in people's homes. Now we want these really clean homes. We're all running air cleaners in our houses and HEPA vacuums and stuff like that. So when a fire happens outside of your house, there's a lot of pollution that does get into your home. Smoke damage, microscopic particles, those kinds of things. Those weren't really existing claims 10, 20 years ago. Now they're becoming a pretty significant portion. So again, it's I see both sides of it, right? I mean, one of the things we talked about too off the air was just how you kind of get what you pay for, right? A lot of these insurance companies that do charge more, they tend to pay out more in claims. The people that are not doing that, if they're not financially solvent when you need them, that's a problem.
person in Westlake, I mean, they had a horror story with Chubb. I mean, I think it was a few years ago there with Chubb Insurance. And obviously, if you're in Westlake, you know how hard it is to find a good company. I would say Chubb is still top, top. But they had basically said that Chubb had denied one of their neighbors' claims. Like something had happened. It was like one of the Woodsley fires or something, I think, had torn through that area in 2018, kind of messed it up a bit. Obviously, that's horrific. And insurance companies, the whole point is for them to be there. But apparently, Chubb wasn't there for one person. And
And
I
that's the other
certainly.
thing. You hear about the one story where somebody claims this didn't happen or that did happen, but nobody knows what the specifics were, right? I mean, every single claim that we help our clients with, just to kind of try to get them through it, there's a point at which they get frustrated and they just want the process over. And one of the things we might have touched on priorly was, like replacement cost of personal contents. If you say you lost 20 pairs of jeans in a fire and you only buy back 5 pairs of jeans, they're not going to necessarily give you that full cash back on those full 20 pairs unless you actually went out there and replaced them. So there's some wording in some of these policies that does require a level of activity by our clients and our insureds. And part of our job, I feel like, is to educate them, pre-claim, talking about coverages, post-claim, and how to navigate that claims process to, get the outcome they need for them and their family.
Yeah, so the claims process, obviously, and then like all the steps beforehand that you had mentioned, like the most important thing is picking the good company with the good coverage that, there's less questions that you have to ask, right? Because you either know the answers to the questions or they're not even questions. They're just, hey, this is done. This is dealt with. And I was going to get to Chubb also. It was just that one story that they had had a poor experience with. They had also had a neighbor that was like, during those wildfires, they had lost everything or something, and like their house, everything. Chubb helped them rebuild it from the ground up, walk them through that entire process, just no questions asked. Like, that was a traumatic experience, obviously, for the family, and they understood that, and they put the client first. And so I would say, if you're in one of those areas, if you're eligible for Chubb insurance, like definitely, go for that.
Consider it.
Yeah.
Consider it, right? It
Even if
costs
it's
nothing to
more.
think about it.
Yeah, it costs nothing to think about. It costs, it might cost, 10, 20, 30, whatever it is to switch, but it's worth exploring, worth talking to your family about, worth talking to your broker about, and saying like, hey, if you've got an inkling that something's gonna happen, like an earthquake, or like, I mean, some people feel like they've got that sort of, what is it, that mindset that they just know it's gonna happen, psychic. You, hopefully, you don't, but if you do, and you feel like there's gonna be a wildfire that's gonna swipe through Westwood, or not Westwood, that's where I live,
That's
Westlake,
where you live,
then
yeah.
obviously go with Chubb Insurance, and talk to them about that and make sure what you have a feeling is going to happen is actually covered under that policy form. But you had mentioned replacement costs. So coverage C on that personal property is a really, really, really big thing, especially for these custom homes, right?
Yeah, I mean, replacement cost for homes is a really big thing. You're talking about A or C. I don't know which number you're talking about better, but the point is,
Dwelling coverage A is obviously that's the property, but I'm talking about like also if you have like custom grade furniture inside of that house, like that should be replaced.
yeah, I got a guy right now going through a claim with Travelers, and $36,000 sofa. Right? I mean, sounds expensive, right? But that's what he had, and he had a e-bike fire in his house, and it's a real claim. It's a real problem. And I believe they're going to pay it, no problem. But again, they didn't just cut him a check for that money. He had to go out and actually buy the sofa, prove that that was like his old sofa. There were some hoops he had to jump through to get that paid. So it's not without any kind of work on behalf of the insured. I mean, our biggest risk, or our biggest advice to our clients, is don't have claims, right? Because it's not worth it. Number one, it's horrible. Even if your house did get rebuilt and everything else, there's a lot of things, sentimental things, you can't replace, right? So we definitely want to recommend to clients that they keep the brush trimmed back from their houses, the roofs clear, that kind of stuff. But getting back to your personal property numbers, yeah, definitely, it all matters. Also, one thing is, what are the sublimits on some of these things, right? Some of these jewelry limits are pretty small. We have some clients that
I've
have
got some of the
100 grand.
numbers up.
Some of the people have 100 grand plus of jewelry. It sounds crazy to some people, but to some people, it's like, Brian, I got a lot more than that. And so it's important that they at least be aware that for about 1% or so a year, they could have that insured, for theft or loss or whatever. And that's real coverage for them, right? That's a real peace of mind. But it is a real expense, and it's that trade off of how do you protect yourself versus not, being overinsured versus being underinsured.
Yeah, you had mentioned specifically the jewelry aspect and the scheduled property. Um, I actually have a few numbers up. So obviously, we work with some of these companies. They're great companies. It might not be the right company if you are a higher net worth individual, and that's what this podcast is about. So Mercury does have a predefined fine art limit of $5,000. Travelers has a predefined fine limit of $1,000. And Farmers says that a typical California policy may limit jewelry, silverware, and collectibles to about $2,000, and that high value art may need floaters. So you'd have to add that manually on. Obviously, like you might not immediately know, hey, like I've got this, and this, and that's worth this, and this much, right? You might need to get it appraised, or you might need to talk to your insurance broker. Say, I've got this. How much should I get it covered for? And then Chubb Insurance is pretty much very, very, very flexible on all of those sublimits. And they add those things to the policy. They talk with you and they add those things manually one by one to try and understand. Obviously, there are other good companies too. I bet Travelers High Net Worth Individual Insurance offers a similar thing where you're able to schedule these things on. But if you are in a unique situation and you have unique things and they are worth a unique amount of money, then the likelihood is that Farmers Insurance, State Farm Insurance, these insurance companies on their standard policies are not going to properly cover you for those things in your house.
And the second part of that too is, with these fine art policies, these collectors policies, they typically are written on an agreed value basis. And what that means is you've taken your collection and your pieces in, or had somebody come to your home to evaluate them, your watch collection, whatever it is, jewelry, and they've evaluated what that property is worth, and they've itemized that list. They've already got the inventory and accounting done. They know the condition. They've taken pictures of everything, and the professional evaluator says you have $200,000 in watches here and 200 grand in art, and you take that to an underwriter. Now, some of these companies, they don't not really specializing in doing these personal article floaters, but there are programs that we have access to that's all these companies do is personal article floaters. And so they have a little more flexibility, a little more leniency, and they can do higher collections. So if you have like a $5 to $10 million art collection, which honestly sounds like a lot of money, but we've had a couple clients spend 20 to 50 grand on art, 20 years ago. And now it's, 10 million plus. And, that's a big portion of their net worth for some paintings that hang over their fireplace, right? I mean, it's crazy to think like that. Even them, some of the clients I'm thinking of, they're like, Brian, you wouldn't believe this. I spent 10 grand on this thing and now it's, $6 million for this painting. I mean, so just be aware that even if the stuff you have, you don't think has value, it may have more value than you realize. So every so often I do recommend that people do have collections of stuff, at least keep a pulse on it, or maybe have somebody you bought that piece of artwork from say, hey, I got that piece of artwork from you, 10, 20 years ago. What do you think it's worth these days? And they might say nothing, or they might come back and say, well, it's now, $2 million. And you might have to decide if you like that painting enough to keep it in your home.
And if you like it enough to keep it in your home and you don't say anything to your insurance broker, then all likelihood is if something happens to that home or something happens to that piece of art, you are not going to be able to get reimbursed for it. And obviously there's no replacing a piece of art, but if you really, really, really love it.
But you're out the money. You're out the money. I mean, and that's the thing that we're trying to talk about is how these seemingly little things, they are material to somebody's well-being and their financial well-being, and again, maybe it's worth 10 grand a year to have that painting over your fireplace. And if it keeps going up by 100 grand a year, maybe it is, maybe that's a no-brainer decision for you to make. But again, not everybody makes that same decision, but you need to go into it at least knowing what you have, what you don't have covered.
100%. And obviously choosing whether you prioritize the yearly premium for, like you had said in the beginning, saving $5,000 to $6,000 just in general with a, potentially worse company, potentially a little bit lower coverages, or if you value that home being replaced in the event of a loss. If you don't think anything's going to happen to that house, I mean, God knows we've seen people, there are people in the Palisades, people thought they were invincible, right? I mean, obviously, and then fire comes through, nature comes through and it changes everything. I mean, I actually have a story. So my cousins had just went to Iceland, and there they got hit with a gale just like out of nowhere, and they had to go inside, and it was very stressful. And there were cars that were like, off the road and things like that because of how horrible the weather is there. And what my aunt and what my little cousins has told me is that they learned there that nature is not something to be messed with. And obviously we've had the signs of it in California, the fires, I mean, the occasional earthquake, right? But I mean, it's serious. You should have insurance for these things just in case something does happen. And if it never happens, then I would be grateful that it didn't happen. And that if it did happen in another life, then it was covered. I mean, you don't want to, it's not worth gambling your house. It's not worth gambling, your kid's safety if they go drive without auto insurance, right? When they come home from college, it's not worth the risk. It's not worth, the saving of a few $1,000s to, not have that home that your kids grew up in, or that you spent all of your emotional energy putting into getting that house, right? You've worked so hard to get here. You've worked so hard, these high net worth individuals, even the low net worth individuals, to get where you're at. Why would you not just again, I firmly believe, spend 1-2% of what it's worth to make sure that you get 100% of what it's worth if something happens. You don't mess with nature, do you, Dad?
Yeah, well, it's an interesting thing. The other thing that, about that replacement cost we didn't talk about a minute ago, but, one thing we definitely learned from these Palisades fires, or relearned, I guess, or all big fires, really, Paradise even, is that after a fire, the cost of construction goes up. And what I mean by that is what cost, $500,000 to rebuild 3 years ago or 4 years ago might be $800,000 or $900,000 now, because material costs have gone up, labor costs have gone up. The permitting expenses is something that people can't even wrap their head around. I've got clients that are trying to do commercial buildings, replace electrical panels with SoCal Edison, and some of them are even contractors, and they're projecting a 9 to 12 month, time just to replace an electrical panel. And he's like, Brian, I could do it in an afternoon. I got crews, I got people. and I can get permits. I can even get the permitting, but SoCal Edison has to sign off. And these are the things. There's things that you and I don't think about and we don't know, and our clients don't know that impact all these things. So even things like loss of use. Think about loss of use. That went up quite a bit too after the Palisades fires. There's no more houses in Palisades. Like, you're not living in Palisades. We had clients that had to go down to Marina Del Rey. I mean, doesn't sound like much, but it's a good 25, miles. Maybe it's a 30, 40-minute drive, depending on traffic. I mean, these are substantial life changes that people have had to endure. Now, in California, you can rebuild in a different location. There could be some other opportunities. You could, get your dream house in, Napa, I guess. But, the problem is there's no free lunch. You do get what you pay for on coverages. But definitely educate yourself. Don't just assume that because it's cheaper, it's going to be better for your family. Like, I think that's the dangerous precedent that I'm kind of worried about. And the other thing that I think we want to mention more time, is the idea of bundling. Chubb might have higher, minimum premiums, but they can package all of your policies under one roof, like for example. And if they do that, same with Mercury, if you're, medium wealth sort of person, it's like average. It's like, that can be a tremendous savings for you. And, it can really help you, know that you're covered by a good company. When we start, piecing together coverages or not knowing things, then we're more worried.
Yeah, you had mentioned like Mercury and like Chubb and like bundling, and even if it's around the same price or an extra $100, $200, having everything in one under one roof. I mean, if you're insuring everything with them, and obviously you have one claim, like, I mean, because something would happen to one of your properties, hopefully, it's like, oh, this is like a family. It's like a family thing. It's like with your insurance broker, you want to have that close knit relationship, so you can tell them when things happen in your life, so you can update those policies when you have something, like a claim come through and they help gun for you, right? Making sure that it's worth it, I would say, to spend a couple extra $100 or whatever it may be to bundle it. More than that, I mean, depending on your net worth, like it's monumental and colossal for claims handling. The more policies that you have with a company, it's an unsaid truth that the more policies and the more you've paid a company, it just makes sense. The more you've paid a company, the more likely they are to pay you.
Yeah, and also just bundling in general. I mean, it makes your life easier. Some of these places, also have this idea that you have to, have like different payment approaches. Some of the excess surplus lines companies want all their money up front, or you've got to premium finance it. Whereas if you go from a more preferred company, right, they might charge you $7 a month installment fees, right? So if you're paying $50,000 in premium at 10%, you could be paying extra thousands of dollars of cost that are kind of hidden or you don't think about, as opposed to being with a more preferred company. Plus, honestly, you're supposed to go with an admitted company if an admitted company will give you a quote. I mean, that's the bottom line too. If you can get an admitted company, you get some level of guarantee from the California Insurance Guarantee Association, SIGA. It's a good thing. But even places like Nevada, you got the same thing going on there for liability. They want you to use admitted companies. They want you to actually get the best value you can. And the State Department of Insurance knows that they regulate those in-house companies.
You had mentioned get the best value you can, and that reminded me of a conversation I had yesterday. So I was reviewing my grandma's earthquake insurance policy because my dad delegates all of that sort of work to me. I completely understand. I mean, I understand like all the policy forms and stuff. And so basically she had sent me this earthquake form that she had received, and her earthquake policy was estimating that her home's replacement cost was around $615,000. Her current homeowners was 570. She had it extended replacement cost to 50%. So like obviously like that seems like around the ballpark area. Maybe we can up it a little bit, but still it seemed good. I looked at the way it was underwritten, her current homeowners insurance policy, and I looked at coverage C, and I saw that it was almost 80% of coverage A. So that's a little trick. If you look at your policy form and you look at coverage A and it says, let's say it's like $3 million, and you look at coverage C and it says like $2.3 million. If you have $2.3 million in personal property, don't change that. But some companies do offer that to be lowered to like 50%, right? To these lower numbers that maybe more accurately reflect your personal property. It could save you, if you're like my grandma's, has a house and things like that, it could save her a few $100s. That's groceries. That's a nice dinner out with some people. I mean, it's something that could be seriously substantial. I don't know what she's got in her house. Dad, she's got in her house that's worth like 500 grand? I'm like, what? Like,
Well, and that's the other weird thing is they throw those things in standard on a lot of these policies, and sometimes you can get them lowered for a little bit of money. The flip side, us as agents and brokers, is we have this concern that if we lower it too much, and you're underinsured, they'll get mad at us, right? And we don't want to have that situation either. So to save $20, if that's what it is, we probably wouldn't recommend it. But if it is several
I
hundred,
would say, okay. I've got another example though. So I've
okay.
got this new client with this higher value house. First off, I would argue with anybody that if you add up all the totals of my grandmother's personal property inside of her house, it does not add up to $500,000, and that lowering it to $300,000 would be much more worth it to save the $200 because there's literally nothing that $200,000
And
would
you'd have to
cover.
prove it in the case of a loss, right? We talked about before. You'd actually have to rebuy that stuff and all that kind of stuff. She doesn't want that much junk
It
anyway. So
wouldn't
I
add
agree.
up to that much money.
Yeah.
But this home also that I'm working on of this higher net worth person, they have millions of dollars of personal property. It's like, okay, I kind of don't want to question that. But then when I talked to them about it, it looked like last year and like the years before when we had their policy with another company, it looked like the thing was like 3.8 million. Because again, like you say, it's just standard and you don't question it. It's just the way that it's underwritten. You don't ask questions. But I mean, like you say, you got to go buy that thing again. We're not telling you to lower your coverages on coverage C for your personal property. We're not telling you to do that. We're just saying if that number looks obscenely high and you talk to your broker about it and they're like, yeah, what do you have going? Like some 1800s Danish teak thing that's like irreplaceable that you'd have to go back and hire Benjamin Franklin back then to like construct it handmade for you. Like I totally get that. Like, but I mean,
You might
realistically,
want that scheduled though. You might want that appraised and an agreed
yes.
value as opposed to just them calling it a yard sale item or something, right? I mean, or IKEA furniture. So I mean, you gotta use a little common sense here.
It
But no,
depends.
I hear you.
Obviously, it all depends. But I mean, the premise is the same. Like, I mean, like you look at some of these coverages, if you run a replacement cost estimator, some of them are free online. We can offer to do that for you on your behalf. You take a look at that replacement cost estimator, you look at that value. If that thing is like a bunch off from your coverage and your policy, it could be really low. It could be really, really, really high. You could be paying too much. You could be paying too little. And I personally would be paying about just right because if you're paying too little, you're not going to be fully covered. You're paying too much, you're going to be over covered. And so it's like finding that fine line. That's just a relationship with your broker. That's just them doing their job properly. And I mean, that's
And historically around the state, and it's something actually at the national conference a couple years ago we talked about some of our California brokers, personal lines people, even commercial lines people too, is that these replacement cost estimators that these insurance companies are using, they tend to be too low. When you actually have to rebuild something in California and you go out and you get bids from different builders, it's shocking how big these numbers actually get. I mean, it's totally different. We might say $200 to $400 a square foot. I've got some clients that their flooring is $80 a square foot. I mean, you just don't know. It just depends.
Yeah, I mean, it does depends. It fluctuates. And obviously, if you're in that upper echelon of people and risks, that also comes with a bunch of different liabilities. So, not just your property exposure, but a bunch of different liabilities. We are going to talk about that in our next podcast. We're going to talk about the unique liabilities that people in general and also high net worth people are, in danger of happening to them and their families and their livelihoods and their businesses. And I mean, there's a bunch of things that you can talk about in terms of unique risks that, I mean, they come after you, Dad. They come after the people who've got the big pockets.
Anytime the attorneys see somebody with money, you're a target. It's just true. It's unfortunate, but it's true. But on a happier note, what else we want to end with besides that bad news?
Okay. So we're going to actually reframe that. We're going to say that we are teaching people how to properly set up some of their liability exposures based on their needs and based on their exposure. We'll talk about umbrellas. We'll talk about different policies that can be scheduled. We'll talk about your umbrella company and how the coverage form is very important. We'll talk about when drivers aren't included, excluded on that policy, and pretty much just how to optimize your insurance plan based on your liability exposure, which everybody knows, I think, in California is up and up and up and up and up. You see the
And other
billboard?
states too. Don't just bash California. I mean,
I see the
Vegas
billboard.
Vegas is rough on the auto too, and a lot of states are. I mean, we were with Colorado people a few months ago, and they were complaining about their situation out there. So every state, I think, has their own challenges when it comes to insurance, and I think that the target on people's back only changes a little bit state to state. I think there's still, in general, pressure to try to get people who have wealth
We will
in the
bring
right.
up those examples, like the Nevada
Yeah,
example, like the California example. Of course, we'll
yeah.
we'll try and diversify it, but most of our experience and expertise comes from California, as you might
So
know.
we're SoCal based, exactly. Yes, or
Exactly.
Central California
But
too. Yep.
liability exposures, right? I mean, hopefully we covered our email in this podcast.
Buy more insurance.
Yeah. Do not lower coverage C. No, seriously. I mean, just talk to your
If you
broker.
can afford it. I mean, that's it. I mean, this is where it's a business decision for people to make, and they need to do what's best for themselves and their families. And they got to be educated. They need to make informed decisions. And at the end of it, that's all we can do is inform people.
All we can do is inform people. If we're your broker, we can directly one-on-one talk with you about it. If we're not even your broker and you want to talk to us about it, we might be able to help out a little bit. I mean, we're just here to consult and advise. We've got a website with a bunch of information on it. We just added a new page for high net worth individuals. So if you want to take a peek at that and see some of the property, stuff and the liability stuff and get a sneak peek in the next podcast, then you're more than welcome to do that. It's on our website, bullinshirt.com/high-net-worth-individuals. So it's a mouthful, but
Is there a .com in there somewhere too?
somewhere. Maybe it's bullinshirt.com/that. Just whatever.
Okay.
Just go to bullinshirt.com. Bullinshirt.com.
That's easy. There you go. There you go. Perfect. Okay. Great ads. Okay. Thank you, son. You take care.
Yep. You too. Talk to you later. Bye-bye.